Everyone, and thank you for joining us to discuss the Baden portfolio investment opportunity. I'm Andrew Gaines and joined by Rob Gaines and Jason Bailey. Unfortunately, due to a scheduling conflict, Joe Pendon is not able to join us tonight. So we'll be covering for him. I'll start sharing my screen here. And we'll dive right in. So we're excited to bring this opportunity to you. We're partnering with Nest Egg RX, to whom I'll introduce you in a few minutes. But this is a 2-property portfolio deal in the Pittsburgh, Pennsylvania MSA, at 152 units. Just a brief disclosure here about the fact that the webinar itself is not an offering to sell securities. If you're interested in investing in this project, you do need to read the legal documents, which will be made available to you. All right, this is our executive summary. I'm just going to cover at a high level all the key points that you need to know to be fully informed and consider whether this is a good fit for you. As I said, this is a 152 unit 2-property project. The purchase price is 10.5 million, and we're planning to execute a value add strategy. And you can see the projected target returns on the right. The 16.6 ARR, a projected internal rate of return of 14.5%, and a really nice projected equity multiple of 2.66, with really strong cash flow of almost 12% throughout the life of the project. In addition, we think it's very possible that we'll be able to return approximately 60% of your initial equity by year 3 through a combination of refinance proceeds and also cash flow in the first few years of the project. We think that a future sale price of 20 million is a very achievable target. A couple other points to highlight. We like this project because it has a significant moat around it and a lot of equity just waiting to be unlocked. Current ownership is really not professional ownership and absentee in many ways. And so as you'll see, these assets are really undermanaged and under-renovated, have a lot of deferred maintenance, and the rents are currently well below market comparables. So we think there's a lot that can be done both operationally and on the renovation side to increase the value in a relatively short period of time. And we'll show you how we think that we can unlock $6 million of value in the first 3 years with strategic operational improvements and renovations. I also want to highlight this as a very conservatively underwritten project. And what I mean by that is, for example, after the renovations are complete in years 1 and 2, we're projecting only 3% rent growth for the rest of the hold period, which is a very conservative kind of slow growth type of number, what you would expect. I mean, it's basically CPI. We're adding CPI to the rent every year going forward. Not estimating big numbers in order to achieve the targets that we are presenting to you today. We'll be obtaining fixed rate debt at 6.5%, with a plan to refinance into an agency loan, which is the best kind of debt to put on a multifamily project. There's nobody more conservative in underwriting projects than the agencies. And finally, we're projecting that the entry cap rate and the exit cap rate will be about the same. The exit cap rate for this project is actually about 25 basis points higher than the purchase cap. All right, so moving on to the team. I think you know who we are for the most part, so I won't spend a lot of time here, but I want to introduce you to one of our co-GP partners. Dennis Bethel is a person that the four of us have known for probably 10 years now. We've invested alongside him, mentored with him to some extent, and seen him um, operate in the multifamily space. Though he is a physician by training, he's been in the multifamily business for 20 years at this point, and has been very successful in raising capital and executing on projects. Um, and he is joined by Chris Justin, his managing partner at Nest Egg RX. The second half of the co-GB team is Rice Pegger. This group is based in Pennsylvania. These guys were born and raised in the area, and they have been doing value add multifamily in this location for the last 8 years, and doing so very successfully. So they will be the project managers for all the construction. They also have um, uh, in-house property management. So they'll be managing the property management side as well as the construction management side uh, as the co-GP partner. Just want to give you a couple of quick examples of the successes that they have had recently. This is a 62 unit in Rochester, PA that they acquired in 2021 and performed a pretty heavy lift value add, and were able to return their investors' capital within a couple of years at some very impressive numbers in terms of the total return and average annual return that they achieved. The second project is similar, a little bit different. In this case, they actually took a motel and converted it into a small apartment building and leased it up very quickly after renovating it, and achieving very excellent revenue growth. So the reason that I'm highlighting these two case studies is because these projects are very similar to what we're going to show you in the rest of this presentation. This is a classic value add project, and this GP team is very experienced in executing successfully on these type of projects. So just quickly, I want to review at a high level again why we like multifamily, why we continue to invest in multifamily, even in 2025 and over the last few years. There's really just nothing like it. We, like most of you, have a conventional kind of buy and hold, diversified portfolio. And there are several studies out there which show that by adding private real estate to that type of portfolio, you can significantly decrease the volatility of the portfolio as a whole, and increase the consistency of your positive returns. So it really is a truly diversifying strategy to add private real estate to a conventional asset allocation portfolio. Real estate tends to continue to perform even in inflationary environments because the cost of everything rises in an inflationary environment, and rents tend to keep up, at least maintain the pace of inflation, if not a little bit better. Real estate is a heavily tax advantaged way to invest. The depreciation often can offset your passive income from these type of projects entirely and make that income entirely tax-free. And then in addition, this year, the bonus depreciation rules were made permanent going forward. So there's an opportunity to really accelerate that depreciation for those to whom that might be beneficial. And then the last thing I'll say is an investment in multifamily real estate is really an investment in a basic necessity of housing. The demand for this is not going away, and continues to be a resilient demand for the product. Okay, so this is a chart of the National Council of Real Estate Private Real Estate Index. This is basically the S&P 500 index of private real estate, and just shows the performance of that over the last 30 or 40 years. As you can see, there have been drawdowns. It's cyclical in nature, just like everything, but those have tended to be fairly shallow and fairly short-lived. We don't see drawdowns of 50, 60% like you can see with a stock market index commonly. And so the main point is this is a truly diversifying strategy to add private real estate to your portfolio. And again, that's why we like it a lot. All right, Will, this project is in the Pittsburgh MSA. And while Pittsburgh may not have been on your radar, it actually should be. It has been a steady growth market over the last few years with positive rent growth, where many markets in the Sun Belt, for example, Texas, Arizona, have had significant rent declines. Pittsburgh has continued to be kind of a slow and steady a market with good fundamentals. They have top-tier universities. They're building out their tech sector. In fact, robotics and AI development is something that Pittsburgh is becoming a nexus for, and has prospects of becoming a future center for the development of the technologies of the future. This is a workforce housing product, and what I mean by that is blue-collar tenants with steady jobs who can't necessarily afford to buy a house. So they're renters by necessity, and therefore these are potentially long-term tenants, and they are underserved in the market relative to a higher level tenant. Developers are simply not building product for this part of the market. What gets built is primarily luxury or Class A apartments. And so that creates a significant supply and demand gap. There's a lot more demand than there is supply. And so this is a section of the market that we think needs to be served and can be served profitably. So when I think about value add, I think of it like as being the value investing, akin to value investing in, stock market investing, where you have an expert analyst who identifies a good business that has strong cash flow, is in a stable industry, but whose stock price is lower than it really should be, as compared to what the business fundamentals would suggest. That's exactly what this type of project is, with the exception of the fact that we have complete control over the execution of the business plan. So rather than waiting for the market to recognize the value and bid up the price of the stock, like in the former example, we control the execution of the business plan, and we can actually create that increased value in the project by making operational improvements and renovating the units and justifying the rental increases. All right, at this point, I'll turn it over to Jason to give you more specifics about these properties.
All right. So I'm going to go over our CapEx and investment overview plan. So we're going to perform sensible but significant upgrades for these properties. As Andrew said, this was a very distressed absentee owner that bought multiple properties and neglected them. When he bought these apartments, he managed to profit from them for a few years, but now he's looking to sell now that deferred maintenance has piled up. Because he was distressed, our team was able to negotiate a deal that was 30% below comparable sales. So the distressed current owner of Pinecone Village, for example, did manage to upgrade about 30 units. Now, it was done in a haphazard way, but he did, and he was able to achieve market rents. We plan to upgrade another 70 units to an even higher standard that our residents will be happy to come home to. Next slide. For exterior renovations, for Pinecone Village, we're going to refresh the exteriors, resurface the parking lots, and add a new HVAC unit to the property. And for Virginia Terrace, we're going to add new windows, pitch the roof, and both areas will have extensive exterior overhauls. Next slide. For the interior renovations, as you can see on the left, you see what the classic units look like. They're kind of old, decrepit, and they need a lot of upgrades. And so the current owner was very haphazard and has a non-standardized way of upgrading his units. So for us, we will do standard, attractive upgrades. We'll be able to get our appliances and furnishings at bulk prices and get them rented at much higher prices. Next slide. Um, so comparing us to the current owner is absentee. He did not have an internet presence. He pretty much got his tenants by people would drive by on the road and see that there was a space available. Well, he also had no on-site presence, and there was a backlog of deferred maintenance. We are going to have a professional on-site manager, a website, an online rental payment portal, and we'll raise rents to market prices post upgrades. We'll also be able to provide and look at backend analytics so that we can provide continuous improvements to the property over time. Next slide. So we're going to be infusing about $2 million into the property. And at year three, when we refinance, we expect to extract about $6 million in equity to the property. You can review all these upgrades when you review the webinar. So it's because it's a pretty dense slide here. Next slide. So for this market, this Pittsburgh market, you can see within a 5 mile radius, there's pretty much nothing else around here. And so most of the people who are in rental units are going to be concentrated in these 2 units. And so it really just makes a really attractive market and a compelling investment, something that we're not actually typically used to, but it does make for a compelling investment opportunity. Next slide. Just to talk about Pinecone Village, it's a 100-unit multifamily community with a mix of 1, 2, and 3 bedroom units. Current rents are about $812 a month per unit, but once stabilized, we project that we can get a 20% bump in rents. With a balanced mix of units, this makes for a compelling investment. Next slide. Virginia Terrace is a 52-unit multifamily property with a balanced mix of studio, 1 bedroom, and 2 bedroom apartments. Current rents are about $757 per unit, and we're projecting that we can raise rents to about $936 per unit, which constitutes about a 23% bump in rents. So this suggests a very strong value add opportunity. So now I'm going to pass it on to Rob. He can go over to the details of the deal itself.
Awesome. Thank you. So here is the current timeline of the deal from purchase to close. As you can see here in Q3 of 2025, the operations and marketing improvement begins immediately. And then we'll be injecting all of our CapEx and doing those improvements in year one through 2026. And from 2027 on to close, there will be quarterly distributions. But as you see in Q4 of 2028, that's about year three, we will target refinance and distribute some of the proceeds. Next slide. Here are some of the details of the sources of income. We will have about $9.7 million worth of loan, and then we'll be injecting about 3.7 million of investor capital along with our co-GPs. Our fund will be a part of that group. The uses of the capital will be 10.5 for the purchase price. We'll have about $2 million worth of renovation, around 340,000 worth of closing costs, and some fees and working capital as well. Next slide. This is a very conservatively underwritten deal, with assuming the cap rate is a 7.25 at refinance and disposition. The interest rate stays at 6.5, and only assuming a 3% rent increase year over year is very conservative. And that's bare minimum for multifamily. But as you can see, the internal rate of return is about 14.5%. The average annual return is about 16.6, and the equity multiple would be about 2.66. Next slide. So back with the debt, like I said before, the loan will be a 5-year fixed loan with about 75% loan to cost, and that loan amount will be about 9.7 million. And it is a 5-year loan, but our intention is to refi after year 3, since it will be a interest only for the first 3 years. We will want to refi after that. Next slide. So this is the financials of the details of the deal. You can see here in year 1 where the operating income is. We will be injecting about $2 million of capital for our operations and CapEx, and there is a significant bump from year 1 to year 3. That's covering all of our operating income just from adding value of $2 million of injected capital will return about $6 million of increased value. And that's assuming the same valuation of cap rate. Um, and then also with our break-even occupancy, first year is about 90%, and then that decreases to 71% of occupancy for break-even. So that is a very generous percent. So it allows us to have a lot of margin. And then another uh, row to look at is for the debt service coverage ratio. That in year 1 is over a point, which means that it will have positive cash flow in year 1, even due to all of the renovations and value add. Um, so this allows us to stabilize the deal in year 1 and then refinance in year 3. Next slide. So here is the investment return scenarios. We have a $50,000 investor scenario and a $100,000 investor scenario. As you can see, year 1, there will not be any returns because we do want to stabilize the deal, and that's very normal with high value add. And then about year 3, that is the refinance capital return. Big cash distribution. That's about 60% of your initial capital invested. And then throughout the deal by year 10, you can see the $50,000 will be around that 2.66 equity return at 135, and similar for the $100,000 investor at 2.66. Next slide. So our incentives are aligned with yours. So with the distributions upon sale of the asset, the LPs receive the remaining of the investment capital. This chart basically gives us a example of the different sale prices at year 10. So we think that we could sell this property or this portfolio for about $20 million. But here's a range if we overperform or come close to that projection. And our LP-GP split is about 96 to 4, up to $20 million. And anything after $20 million, it will be a 60-40 split. Next slide. And this is about how to invest. We have a deal page. You can either click this link or scan our QR code, and we have a investor page where it has all the details of this deal on our website. You can rewatch the webinar or see the financials and have the slides as a download. And then we have an Invest Now button, which allows you to fill out a form. This way, we will be able to have you as a soft commit, and that way you can express interest by filling out that form. And then once you do fill out that form, then you can review the offering documents, the PPM, and that will be available by September 15th. And then you can fund your investment after that. And our finalized commitment date is October 8th. And if you have any questions, please feel free to reach out to any of us. We look forward to hearing from you, and we just thank you for your time.